if a commodities trader were to tell you that a market is in contango, they're just referring to the idea that it is cheaper today. So if you're talking about now, it's cheaper to buy that commodity on the spot market. So it's cheaper to buy it on the spot market than it is to agree to buy it at some futures date or some future date using a futures or forward contract. So in the future, it is more expensive. It is more expensive. So let's say that that commodity is gold, and I'll just make up gold prices for the sake of simplicity. This isn't the current gold prices. Let's say that today you can go on the spot market and buy gold at $1,500 per ounce. But if you wanted to buy gold, if you don't want the gold today, and you want to enter a futures contract to buy the gold 1 year from now, so let's say the future is now 1 year later, 1 year from now, instead of buying the, let me write this down. This is the spot market. Instead of buying it in the spot market for $1,500 an ounce, you could agree to buy it 1 year later, 1 year from now, for $1,600 an ounce. $1,600 an ounce. And so to a trader, this would be a market in contango. And what I want to point out is that this isn't that strange of a thing. Because if you think about it, you have two options. If you want to invest in gold, and gold is something that you want to invest for the long term, you're not going to eat the gold, you're not going to use it to fuel your cars or anything like that. So in the situation with gold, let's say you want to keep gold for definitely a year, but maybe many, many, many years. So you have two ways of making that investment. You could take your $1,500 and buy the gold today. But if you take your $1,500 and buy the gold today, you would lose the returns on that $1,500, on that cash that you could invest other places. So you have the opportunity cost of the cash. So had you invested that cash someplace else, and you also have to store that gold. In the case of gold storage, you have to find someplace really secure, and maybe you need to insure the gold, and you need to, so people can't steal it and all the rest. So you also have the storage cost. Storage cost. In general, you could save both of these costs if you enter into the futures contract. So instead of just buying $1,500 on the spot market today, you could enter into this contract where you can definitely buy the gold 1 year later for $1,600 an ounce. And then you could take your $1,500, and get interest on it. You could get interest on it, so that will grow. And you'll also save money on the storage costs. So in either way, especially for commodities like gold, precious metals, things that aren't consumable, things that people don't need immediately for consumption, it's not unusual for a market to be in contango. Sometimes you might see a severe contango, maybe with something that is consumable. So maybe right now oil is trading at $50 a barrel. Once again, I'm just making up the number. And in the future, the futures price is at $150. So this is probably taking more into account than just the storage cost and the opportunity cost of your cash. And this might be because there's a surplus for oil consumption today. There's just a big glut in the market, and people are just trying to dump it. Or there might be some type of perceived shortage in the future. So you can think about it either way. But this is very unusual. This type of severe contango is very, very unusual. You would expect to see kind of minor ones, things that take this cost into consideration, but not something like this. And something like this, you can usually arbitrage it out and make some money, assuming you can store oil or you have oil to sell or buy and all of the rest of that. Now that we know what a trader means when they say that a market is in contango, let's think about whether it would be a bullish or a bearish signal for prices in that commodity. So as I mentioned in the last video, it's actually normal for things to have a contango because it takes into account the opportunity cost of the cash and the storage cost for that commodity. So if something is kind of in a reasonable contango, you really can't make a call on it one way or the other, whether it's bullish or bearish. It's really just something that you would expect. What's not as usual is a severe contango. severe contango. And that's when the current spot price is a lot lower than the futures price or the forward price. And in that situation, as we mentioned in the last video, it's because that there's perceived to be a big glut in the market. There's a surplus on the spot market, or maybe there's a perceived shortage at some point in the future. And in general, this is perceived, although once again, you can't just look at one simple signal and be able to, bet your life savings on the direction of the market. It's a very quick way to lose your money. But the general view is that a severe contango is a bearish signal, for the future price of that commodity. And the reason why it's perceived to be bearish is because if you have this huge discrepancy, all someone has to do is buy a bunch of oil today. We assume that these were oil prices. So buy a bunch of oil today for cheap, store it, and once again, we're assuming this is a severe contango. So it won't cost $100 a barrel to store this oil for a year, and then we agree to sell it for $150. So we agree to sell it. And assuming the storage cost is less than $100, we're going to guarantee some money. So if you have a bunch of people doing this, buying on the spot market, it will increase demand on the spot market, raise prices there. But for the futures market, there's a bunch of people who are now agreeing to sell in the future. So it's going to increase the supply on the selling side of the futures contract. So it'll lower the futures prices. So in general, severe contango is bearish for the futures price. If a commodities trader tells you that a market is in backwardation, they're essentially saying that it costs more to buy whatever commodity they're talking about now. So now it costs more than it would to buy it later, to go into a futures contract to buy that, whatever that commodity might be, silver, gold, or oil, to buy it later. So later is cheaper, So the question you might ask yourself, or that really any trader might ask themselves, is this bullish or is this bearish? Is this a bullish situation? And there's no obvious rule of thumb here, but if someone says, look, to get something now costs more than to get it later, what does that tell you about what's happening in the market? Well, it tells you that people are desperate. So they are desperate. Because if they weren't desperate, the rational thing to do would just be wait a little while and get it cheaper for later. Or if you don't need that oil right now, or if you don't need that corn right now, or if you don't need that gold right now, instead of paying more for it right now, just say, look, I could enter into a futures contract for delivery of that gold or oil or corn or whatever it is at a later date for a cheaper price. And I wouldn't even have to store it between now and then. So if people were rational and if they weren't desperate, this wouldn't happen. But because they're willing to do this, they're willing to pay more now than for a future delivery date, it shows you that there might be some type of, it tells you that there might be some type of shortage. In the case of oil, maybe the oil supply has been disrupted somehow. In the case of corn, for whatever reason, some crops have been destroyed and people need to eat and all of the rest. For commodities that aren't used, so to speak, like gold, if you see backwardation there, I wouldn't say, I mean, it's definitely still desperation, but it's not out of a core need. If gold goes into backwardation, it's more because of some type of irrational desire to have their hands on the gold now than have their hands on the gold later. Maybe they think society is going to collapse and the future delivery dates of gold aren't going to actually hold up. Who knows what they are? So in general, when people talk about backwardation, because of this desperation in the market, people tend to perceive it as a bullish signal. Obviously, if people are desperate, there's demand for this thing. My argument is you can't just look at one tea leaf out of a bunch of tea leaves and say whether it's bullish or bearish. But what you could say is, look, there's something somewhat abnormal going in the market due to some type of desperation. It's a little less irrational if it's due to a storage, but it could be very irrational if it's due to just wanting your hands on it. Because frankly, if you wanted to buy gold just for the sake of investing in gold, you're not going to eat it or use it to fuel your car or anything like that, it would make complete sense, or even better, if you already held gold in this type of a market that's undergoing backwardation, The rational thing to do would be to sell your gold now for more money and then agree to sell it and then agree to buy it back later for cheaper. And so once this later date comes about, you'll still have your gold and you would have made some risk-free profits. I want to use this video to try to get a better intuition for futures curves, and in particular to understand that the futures curves shows a snapshot in time of the different market prices for essentially the delivery price at different future dates. So when I say that, I know that was kind of a confusing statement. In this futures curve right over here, when you have a delivery date that's 0 months from now, that's essentially today, that's the market price. That is the actual market price of that commodity. In this example, the commodity is silver. So if you were to go out and buy silver today, it would cost you roughly $32. Let me say that this is per ounce. It would cost you $32 per ounce. When I say one out here, this is 1 month in the future. I'm not talking about the price. I'm not talking about the spot price of silver in a month. I'm talking about the price today in the market if you were to agree to buy or sell silver in a month. The futures price for a delivery 1 month out. That's what that is right now. So I want to make it very clear. This is not showing you how the spot price of silver will move over the next 8 months. It's telling you today. If you wanted to transact in silver right now, you would transact at $32 an ounce. If today you agree to transact in silver a month from now, you would buy or sell. It looks at around $33 an ounce. If today you were to agree to buy or sell silver 4 months from now, you would do it at $35 an ounce. If today, I don't want to be redundant, but if today you were to agree to buy or sell silver 8 months from now, and you were to lock in the price, you would lock in a price that looks at like about, I don't know, $36 an ounce. So this is really a snapshot in time. And if, for example, let's say tomorrow the price of silver, there's this huge silver shortage, or people realize a new application for silver that could change the world, then what you would have tomorrow is that this whole curve would probably shift up. The whole curve would shift up something like that. So no matter when you decide to actually transact in the silver, it'll actually get more expensive. But I want to make it very clear that this is just a snapshot in time. And to better understand that, I've also drawn over here how the prices can move it over time, and I've drawn different durations. So in purple right over here, I've drawn the spot price. So this is a spot price today. And over here, this is a spot price today, but then I've shown how it changes in time. So this is kind of closer to a traditional stock chart. This just tells us that, look, the spot price started at $32. It went up a little bit, went down a little bit. It kind of just goes up and down, oscillates a bit over the next 8 months. So this is actual movement over time. This is a snapshot of delivery dates at some point in the future. So the spot price just moves around. And let's just take this green contract right over here. So when we start on the first day, the green contract, if you agree to transact in silver 4 months from now, you're agreeing to transact at about $34. So that's where you would transact right now, that 4-month out contract. But as you move more and more forward in time, you're getting closer and closer to that delivery date. If you move 1 month into the future, now that contract is only going to be 3 months out. You move 2 months in the future, now that contract is only 2 months out. All the way until if you move 4 months out, this contract will now be essentially the spot price because you're now agreeing to transact now. That'll happen 4 months from now, but you'll now be agreeing to transact at that moment. And so at that moment, that price should be the same as the spot price. So you'll have this conversion with the spot price. And the same thing for the 8-month out contract, it should converge over the next 8 months.